Good morning, it's Jeffrey Christian, CPM Group, at 11 o'clock on Friday, the 2nd of September. Talk to you today about a variety of things, and I'm going to try to be relatively quick about them. Talk about the markets, the economic environment that flavors and is flavoring the markets, and a little bit of a postmortem, if I may, on the Silver Symposium. My plan right now is to elaborate on some of these topics next week on Tuesday's video, but that plan, of course, is always subject to change. Should economic and political and market conditions change dramatically between now and next Tuesday, we may be talking about whatever is more important at the time. But we have seen precious metals prices fall sharply over the last period of time, and I'll get back to that in a second, talk about the outlook of it. And then I also, as I said, will talk about the economic environment. Gold prices have fallen back to the lows that we saw in July. Gold, I think, got down to $1,689 on September 1st. We have been saying that we thought a spike down to 1680 or even 1650 was possible during the summer months, specifically June through September. Silver prices have fallen even further. They are now basically back where we're at in the first half of 2020, before the price rose sharply in July and August of 2020. Really July. I think they peaked on August 9th and moved sideways for about a year and a half, and have come back off. Silver prices we've talked about, are more weak than gold prices at present because people around the world are more interested in gold as a financial asset and a portfolio diversifier than they are about silver. And you clearly have disenchanted selling by some investors who listen to all the hype about squeezing silver and draining the silver inventories out of COMEX. And they've realized that they were taken, that the people who were telling them that either didn't know what they were talking about or were consciously and purposefully misleading them. And so you've seen silver sales by investors, and investors have been less interested in silver. So we're seeing much weaker silver prices, and really the last few days have been particularly brutal. The saving grace of all this is that if you look at the stock market, bond markets, currency markets, other commodities have all suffered lower prices too. That tells you that while some of the weakness has been focused on fundamental situations in gold and silver, gold and silver are really moving downward as part of a broad selling off of financial assets. And I think that is partly because of the economic environment that we are going through, and shifting investor attitudes. Investors have backed away from their inflation fears. They're starting to realize that inflation does maybe seem to have peaked. Jeremy Siegel said that he thinks so. They backed away from their fears of higher interest rates, and they've backed away from their fears of a recession. And it's very important, and I think I mentioned this a couple of weeks ago in one of our presentations, to pay less attention to labels. Recession, inflation, hyperinflation, and more attention to the economic realities. The first time I met Alan Greenspan was in 1981. Townsend Greenspan, his company was a consulting company to J. Aaron, and that consulting contract came through the research department, which I was running. And I got to meet him. And I found that he had many sterling qualities, and one of them was one that I shared with him, and that was that he didn't believe in any theories. 1981 was a year of all kinds of cockamamie ill-conceived economic theories. Monetarism. The only thing that matters in the economy and inflation is money supply. Supply side economics. We can run budget deficits up from $50 billion to $350 billion, and it'll be good for the economy because all that stuff will trickle down. There were all kinds of theories, and Alan and I didn't believe any of them. Alan was an empiricist. He was a data hog, as CPM Group is. Don't tell me your theory. Tell me what's going on in the economy. And that's really important. Take a look here. This is real GDP rate of change, percent change on a continuous basis, year over year. And you can see the second quarter, the second estimates of the second quarter data came out, I think last week, and showed the revision was from a negative 0.9% to a negative 0.6% or 0.4%. So from a label or from a theoretical or from a rhetorical perspective, we have been in a recession in the last 2 quarters. Short, shallow recession, but a recession as you label them. The reality is much more different. So if you look at actual GDP, yes, you can see that you've seen some weakness in real GDP. You can also see that we are higher than we were by a wide margin from the pre-pandemic levels, and that the long scope of historical growth in US GDP continues. This is real GDP adjusted for inflation. And you have to look at the economic realities. We've seen inventories fall in corporations, partly because of supply. They couldn't get the inventories to rebuild, partly because they've been worried about the effects of rising interest rates and inflation on demand, and they've been concerned that we're moving into a recession. So corporations consciously have reduced their inventories. That leads to supply shortages, and people say, well, I went to the store and I couldn't find any bananas, so clearly something's wrong with the world and we're going to hell in a handbasket. That was the major driver of the reduction in overall GDP over the last 2 quarters. You've seen a lot of other things that have contributed to it: rising housing prices, mortgage rates, and the fact that people don't think intelligently and prudently about buying a home. They say, how much can I borrow at current mortgage rates? And I'm going to find a house that costs that much, and I'm going to borrow myself up to the hilt, rather than saying what's a reasonable price that I can afford for my housing on a long-term basis. Housing prices have risen, mortgage rates have risen, housing sales have plunged. You've seen pockets of weaknesses, and then you're seeing pockets of strength. This morning, the jobs report came out, and it was very interesting. Unemployment rates actually ticked up to 3.7% from, I think, 3.4%. But the number of jobs that were created were 3,000+ jobs. And what you've seen is a big increase in jobs, employment, economic participation rates. A lot of people, like 60.2 million people, have been sitting on the sidelines, not looking for jobs, not having jobs, not looking for jobs, not trying to find a job. And what we saw last month was a 300,000+ increase in jobs, but a 600+ increase in people who have been sitting on the sidelines are starting to move off the sidelines and trying to find jobs. So you've got pockets of strength, and that is going to continue. So you've got to look at the economic data. Recession that matters. It's what's going on with all of the things that are happening, business, investment, consumer spending, housing, construction, non-residential construction, fiscal policy. All of those factors are there. hearing on the internet, at least among the gold and silver promoters, that it's an either or proposition. We're either going to have hyperinflation or a depression and a collapse of the economy. It's not the case. The vast majority, the highest probability is that we will see the economy doing what it's been doing, kind of moving sideways for a while. You know very well from previous videos, we are expecting a recession at some point in the United States, possibly within a year and a half to 2.5 years. But we're not expecting one right now. The likelihood is that you could see, well, you could call it a muddling through, or you could call it a Fed success. And at the Silver Symposium, just to jump ahead, there was a session, is the Fed trapped, and the Fed can do nothing but choose between one or the other dire consequence. And during the question period, the moderator asked me what I thought. I said, I think that likelihood is that the Fed will raise interest rates. The pace of increase in interest rates over the next 4 months, and then it may stop in the first half of next year. And the market consensus in the real economy, the market, is that the Fed may continue to raise interest rates very slowly in the first quarter, and they may not peak until the second quarter. And that's been a shift. If you go back 6 months ago, people were saying that they thought that the interest rates might peak in the fourth quarter of this year and actually start declining in the first quarter of next year. But as the view of economic realities, that we're not in a deep and persistent recession, and that inflation rates are actually peaking and starting to come down, have set in, people have said, okay, the Fed probably will have to continue to raise interest rates for a little bit longer at a slower pace. And frankly, go back to last Friday, Jerome Powell's speech at the Kansas City Fed's Jackson Hole enclave barbecue was exactly that. To focus on the real economic trends, fiscal policies, and politics. And the politics are becoming much more important to the economy, and they'll continue. So if you look at this, let's compare the two. Say, oh my gosh, we're in a recession. Two periods, 2 quarters of negative contraction in economic activity. Yes, but they're small contractions compared to those bigger spikes down that you see that have been traditional recessions. And overall economic levels, the actual output levels of economic activity, the creation of value, are kind of high. It's the reality there. Talk a little bit about the Silver Symposium. It was Tuesday and Wednesday of this week in Spokane, Washington. It was very good. I think one of the most interesting aspects of it was that there were a couple dozen companies there that are either exploration companies or pre-development companies or development companies. There were a few actual producers there. The producers are doing very well. Even at $17, $18 an ounce, they're profitable and they're growing. But you had, as I said, a couple dozen companies that have very attractive deposits, some of them with very high-grade mineralized zones. And it was interesting because in the one room, you had a lot of these companies saying, hey, take a look at our companies. We have interesting deposits that we can bring into production profitably, even at $17 an ounce. You should invest in our company. And in the other room, you had a couple guys saying, the world's running out of silver. There's no mineable silver left. There's no high-grade silver left to be mined. And basically speaking, a lot of nonsense. It's just not true. In the one room, you had people with degrees in geology and mining engineering. and metallurgy and finance and this, saying, look, if we get the capital, we can build very attractive mining companies. And in the other room, you had guys, Lord knows what their real background is, saying, no, the world's running out of silver. You also heard a couple of these guys sort of say, hey, listen, I've been telling you for years that silver prices are going to skyrocket. I've been wrong for all that time, but it will happen. Or at least tell you that it's going to happen. At a session Tuesday night, which was the evidence for and against silver conspiracies. And it was a very interesting thing. I spoke for probably 45 minutes, laying out the evidence that conspiracy theorists put forth and showing how it's inaccurate, laying out the evidence that their evidence is not right, is not accurate, laying out the evidence that there is no conspiracy theory, conspiracy to suppress silver prices. And one of the points I made is that there's no motive on the part of banks to suppress the price. The banks earn more. They're more profitable in their gold and silver trading, their gold and silver prices. So you lack a motive. In a court of law, boop, it's gone. But the evidence that's put forth, which is some statistical machinations, is inaccurate. It doesn't prove anything. And the people who say that is there basically are not the kind of people you'd trust with a subway token. So it's kind of interesting. And there were a couple of those people there. And it was very interesting because they didn't come in. They didn't come in to defend the conspiracy theories or to debate them. They didn't come in to hear what we were saying about the conspiracy theories and the lack of evidence supporting them. They didn't come in to learn about the silver market. Interesting. I'm a data hog. I look at the data, we look at what's there, and we go from there. So that's all I have for today. You can buy our yearbooks and learn more. You can become a retail investor client of ours if you are a retail level investor. And there's a host of other things that you can do from us, including purchasing our long-term gold and silver reports, which are relatively pricey. They have 10-year projections of supply, demand, and price under different scenarios. We completed our our third quarter gold yearbook long-term outlook a couple of weeks ago, and the silver long-term outlook will be completed today and released on Tuesday when everybody goes back to work in Canada and the United States. Have a good long weekend if you have a holiday weekend. I know Canada and the United States have Monday off. We're going to try to take it off too, even though we tend to work 7 days a week normally. Have a good weekend. Take care of yourself and those around you. Watch out and take care of for the whole world, because the whole world needs your help right now. Thank you.